If you start with a small account, the first thing you must understand is that the market does not care how small your account is. The market has no sympathy. It does not slow down for beginners, and it does not speed up for professionals. It simply moves as it always has, on supply, demand, fear, and hope. Now let me ask you something. If a man walks into the market with $1,000 and the dream of turning it into a fortune in a week, what do you suppose the market will do to him? It will teach him a lesson, usually an expensive one. Because trading was never about the size of the account. It is about the size of the discipline behind it. A small account is not a disadvantage if you know what you're doing. In fact, sometimes it's the best teacher a trader can have. When the account is small, every dollar matters. Every mistake shows up quickly. Every careless trade leaves a mark, and that pressure forces a man to learn the one thing most traders avoid learning. Patience. You see, the market pays the patient man, but it punishes the restless one. Most beginners with small accounts try to trade every movement on the chart. A little green candle appears and they buy. A red candle appears and they panic. Before long they are jumping in and out of trades like a nervous rabbit in a field of wolves. But let me ask you this. Did you come to the market to gamble on every tick, or did you come to wait for the right opportunity? Because the charts are always speaking. Not loudly, but clearly enough for a man who knows how to listen. Price trends, consolidations, breakouts, pullbacks. These things repeat themselves year after year because human nature never changes. Fear and greed draw the same patterns today that they did decades ago. And the trader who learns to read those patterns gains an edge that has nothing to do with the size of his account. When I first began watching charts, I learned something very important. The big money is not made in the small fluctuations. It is made in the big movements. And here is where many small account traders make their greatest mistake. They believe they must trade constantly to grow their account. They believe activity equals progress. But does it? Think about it. If you take 10 mediocre trades in a week, each one forced and uncertain, what do you really gain? More commissions, more stress, more mistakes. But if you wait, if you study the chart, if you watch a market forming a clear trend, and then you strike when the opportunity is obvious, now you are trading like a professional, even with a small account. You see, charts tell stories. When price begins making higher highs and higher lows, the market is whispering something to you. Demand is stronger than supply. When price breaks above a resistance level that has held it down for weeks, the market is telling you something again. Buyers are gaining control. But here is the part many traders ignore. A signal on the chart is not an invitation to bet everything. It is simply information. And what you do with that information determines whether your small account grows or disappears. A wise trader risks little on each trade. Not because he lacks confidence, but because he understands uncertainty. Even the best chart pattern can fail. Even the strongest trend can reverse. So the professional trader asks a simple question before every trade. How much can I lose if I'm wrong? Notice that he does not ask how much he can make. He asks how much he can lose. Now, why do you suppose that is? Because protecting capital is the first rule of survival in the market. And survival is what allows a small account to grow into a large one. If you risk half your account on one trade, you are not trading. You are gambling. And gamblers do not last long on Wall Street. But if you risk a small portion, perhaps 1 or 2%, then something remarkable happens. Your account becomes resilient. A losing trade no longer destroys you. It becomes simply a cost of doing business. And once a trader reaches that understanding, his mind begins to change. He stops chasing the market. He stops forcing trades. He begins to wait. Let me ask you something. Have you ever watched a chart for hours, maybe days, waiting for the exact moment when price breaks from a tight consolidation? That moment when volume expands and the market suddenly moves with purpose. That is the kind of moment professionals wait for. Because markets spend most of their time doing nothing and only a small portion of time doing something very important. And when that important movement begins, the prepared trader acts with confidence. Now think about the advantage of this approach for a small account. Instead of scattering your capital across dozens of random trades, you focus your attention on the clearest opportunities. You align yourself with the trend. You allow the market's momentum to do the heavy lifting. And slowly, trade by trade, the account begins to grow. Not explosively, not overnight, but steadily. The trader who turns a small account into large profits rarely does it with one spectacular trade. More often he does it with a series of disciplined decisions. He cuts losses quickly. He lets winners run. He adds to positions only when the market proves him right. This last idea is one that beginners often misunderstand. Most people add to losing trades. They average down, hoping the market will come back. But hope is not a strategy. The wise trader does the opposite. He adds only when the market confirms his idea, when price breaks higher, when momentum strengthens, when the trend continues. Then he adds a little more, and suddenly the position begins to compound. Now let me ask you this. What happens when a trader combines patience, discipline, and compounding with even a modest account? Something powerful begins to take place, because the market rewards consistency far more than brilliance. 1% here, 2% there. A strong trend captured and held longer than the crowd expected. The account begins to grow quietly. And while others are chasing quick profits, the disciplined trader is building something far more valuable. A repeatable process. But the real transformation does not happen in the account balance. It happens in the trader's mind. Because once a trader proves to himself that he can grow a small account through patience and chart reading, his entire relationship with money changes. He stops fearing losses. He stops chasing excitement. He begins to see the market the way a seasoned operator sees it, as a place of probabilities rather than predictions. And when that mindset settles in, the charts start to look different. Trends become clearer. False signals become easier to ignore. And the trader begins to realize something that most beginners never understand. The market is not a place to prove how smart you are. It is a place to wait until opportunity becomes obvious. And when it does, you act without hesitation. Now imagine watching a chart where price has been building pressure for weeks, where resistance has been tested again and again, where volume begins creeping higher. And you start to wonder. A small account has a strange way of teaching a trader the lessons he would otherwise ignore. When the account is small, every dollar suddenly feels important. A careless trade is no longer just a mistake on a chart. It is money leaving your pocket, and that pressure forces a man to face the truth about trading sooner than he might like. Because the market has a simple rule, it punishes impulsive behavior. Now think about the typical beginner. He opens a small account and believes the fastest way to grow it is by trading constantly. Every movement on the chart looks like an opportunity. A green candle appears and he rushes in. A breakout happens and he feels afraid to miss it. A red candle shows up and panic starts whispering in his ear. But let me ask you something. If every small movement in the market were truly an opportunity, wouldn't everyone in the world already be rich from trading? The truth is that most of those movements mean very little. They are noise, random fluctuations driven by short-term emotion and indecision, and the trader who jumps at every one of them is not operating with discipline. He is reacting. A small account cannot survive long under that kind of behavior. You see, discipline begins with planning. Before a trader ever clicks the buy or sell button, he must already know why he is taking the trade. The chart should present a clear reason. Perhaps the price has broken above a resistance level. Perhaps a trend has formed with higher highs and higher lows. Perhaps a consolidation has tightened, showing that pressure is building. But even when the chart presents a good opportunity, the disciplined trader asks another question. How much am I willing to risk if this idea is wrong? That question alone separates planning from impulsive trading. An impulsive trader enters a position first and worries about risk later. A disciplined trader defines his risk before the trade even exists. Now imagine two traders with the same small account. The first trader jumps into trades based on excitement. He watches every candle and reacts emotionally. Some trades win, some lose, but his decisions are never consistent. His account balance moves up and down like a ship in rough water. The second trader approaches the market differently. He studies the chart. He waits for the conditions he understands best. When those conditions appear, he enters with a defined plan, entry point, stop loss, and target. Let me ask you which trader is more likely to still have an account 6 months from now. The market does not reward activity. It rewards precision. A small account makes this painfully clear because it cannot absorb endless mistakes. Large funds may survive reckless trades for a while because their capital cushions the damage, but a small account has no such luxury. Every unnecessary trade chips away at it. That is why many successful traders actually value the experience of starting small. It forces them to develop habits that remain valuable even when their account grows larger. They learn to wait for the right setup. They learn to measure risk before entering a trade. They learn that not trading is sometimes the best decision. Have you ever noticed how difficult it is for beginners to sit still while watching a chart? The market is open, candles are moving, and the temptation to act becomes almost unbearable. A trader feels as if he must do something, but discipline often requires doing nothing at all. That is one of the quiet secrets of trading. The best trades are usually obvious in hindsight because they developed slowly. The market spent time building structure, forming support levels, resistance zones, and clear trends. Those who waited patiently could see the opportunity forming long before it arrived. But the impatient trader was too busy chasing small movements to notice. A small account forces you to slow down and observe. You begin to notice how trends develop over time. You see how breakouts often follow long periods of consolidation. You recognize how false signals trap traders who rush in too early. And gradually you start asking yourself a new question before every trade. Is this opportunity truly clear, or am I just bored? That single question can save a small account from countless unnecessary losses, because the disciplined trader understands that every trade must have a purpose. It must fit within a plan. The chart must show a reason that justifies the risk being taken. Otherwise, the trade does not exist. The small account therefore becomes more than just capital. It becomes a training ground for the habits that separate serious traders from hopeful gamblers. And the trader who learns discipline, while his account is small, is quietly preparing himself for the moment when opportunity and experience finally begin to meet on the same chart. For most men come to the market, believing that this lies in constant action. They watch the charts flicker, the candles forming minute by minute, and they feel the urge to participate in every movement. To them, the market looks like a machine that must be worked all day long. But the market is not a machine. It is a place where patience is tested more than intelligence. Let me ask you something. If a hunter walked into the forest and fired his rifle every few minutes just because he was tired of waiting, would you call him skilled? Of course not. You would say he lacks patience. Trading works the same way. The man who feels compelled to trade every fluctuation on the chart is not exercising an edge. He is surrendering to impatience. And impatience is expensive. A trader must understand that the market spends most of its time moving without direction. Prices drift up and down, reacting to small bursts of emotion, minor news, or simple uncertainty among participants. During these periods, the chart may look busy, but the truth is that nothing meaningful is happening. Yet many traders treat these random movements as opportunities. They buy because the price ticked higher for a few minutes. They sell because a candle turned red. Their decisions are driven by motion rather than by structure. But the disciplined trader looks at the same chart and sees something entirely different. He sees that the market is not ready yet. You see, the best opportunities in trading rarely appear suddenly. They build slowly. Pressure accumulates in the market like steam inside a sealed container. Support levels are tested repeatedly. Resistance levels are challenged again and again. Volume begins to increase, and price tightens into a smaller range. This process takes time, and the trader who understands patience knows that this waiting period is not wasted time. It is preparation. Now think about how many traders can actually sit through this stage without doing anything. The candles move, the market breathes, but the disciplined trader remains still. Why? Because he knows that the real opportunity has not arrived yet. Patience is not about laziness. It is about recognizing that a clear setup must exist before capital is placed at risk. Consider a market that has been trending upward for weeks. The price consistently makes higher highs and higher lows. Buyers remain in control, and each pullback is shallow and quickly absorbed. But suddenly the market enters a tight consolidation near its recent high. For several days the price moves sideways, neither breaking higher nor falling apart. Now let me ask you, what is the impatient trader doing at this point? He is jumping in and out of trades inside that narrow range. Buying the top, selling the bottom, reacting to every small fluctuation. Each trade feels urgent, as though something important is happening. But the patient trader sees the situation differently. He recognizes that the market is gathering strength. That tight consolidation is not noise, it is compression. Buyers and sellers are positioning themselves, and eventually one side will gain control. So he waits. He watches the chart carefully. He observes the volume. He studies how the price reacts when it approaches resistance. And then one day the market breaks above that level with strong momentum. Volume expands. The candles stretch higher, showing that demand has overwhelmed supply. That moment is the reward for patience. The trader who waited now has a clear signal. The structure of the chart supports his decision. The trend is already in his favor, and the breakout provides confirmation. Meanwhile, the impatient trader is exhausted. He has spent days chasing meaningless fluctuations and may have already lost confidence or capital before the real opportunity even arrived. This is why patience is an edge. It allows the trader to conserve both energy and capital until the market reveals its intentions. Now consider the psychological advantage of this approach. When a trader knows he does not have to trade constantly, his mind becomes calmer. He is no longer desperate for action. He is simply observing the market, waiting for the right conditions to appear, and when those conditions finally present themselves, he acts with clarity rather than urgency. Have you ever noticed how the best trades often feel almost obvious when they appear? The chart looks clean, the trend is clear, the breakout is decisive. Everything aligns in a way that makes the decision straightforward. But these moments only appear to the trader who has the patience to wait for them, because the market does not reward the man who is always active. It rewards the man who is ready when the right moment arrives. And that moment, more often than not, appears only after long periods of quiet observation. A trader who studies charts long enough begins to notice something curious. The patterns repeat themselves. Not exactly the same every time, but close enough that they feel familiar, almost predictable. At first this can seem strange. The market is filled with millions of participants, investors, institutions, speculators, algorithms, yet the same formations appear again and again. Trends rise and fall in recognizable ways. Prices consolidate before breaking out. Sharp rallies are often followed by corrections that resemble earlier ones. Now let me ask you something. Why would such repetition exist in a market that is constantly changing? The answer is simple. Because the market is driven by people, and people rarely change. Human emotions remain the same today as they were decades ago. Fear still causes traders to sell too quickly. Greed still pushes them to buy too late. Hope still convinces them to hold losing positions longer than they should. And these emotions leave fingerprints on the chart. That is why chart patterns exist at all. Take a simple example in uptrend. When price begins making higher highs and higher lows, it tells a very clear story. Buyers are stepping in aggressively, and each time the market pulls back, new demand appears at a higher level than before. What does that behavior represent? Confidence. Participants believe the price will go higher, so they are willing to buy the dips. This belief gradually pushes the market upward in a staircase pattern, but eventually something changes. The price approaches a level where sellers become more active. Perhaps it is a previous high, or perhaps it is a psychological price level that traders are watching closely. The market begins to stall. Now imagine what is happening in the minds of traders during this moment. Some are excited. They see the strong uptrend and believe the price must break higher soon. They begin buying aggressively, expecting a continuation. Others become cautious. They remember the previous resistance level and worry that the rally may fail. They start selling or taking profits. These opposing emotions create a battle between buyers and sellers. The chart reflects that battle through consolidation. Price moves sideways, candles overlap, and volatility contracts. Have you ever noticed how this kind of structure appears again and again in different markets and time periods? That is because the emotional struggle behind it never disappears. Eventually the tension resolves. If buyers win, the price breaks above resistance and momentum accelerates. Traders who were waiting on the sidelines rush to enter, and those who are short must cover their positions. This sudden burst of activity often creates the familiar breakout pattern. But sometimes the opposite occurs. The resistance holds. Buyers lose confidence. Selling pressure increases, and the market reverses direction. Now think about the role of fear in this moment. Traders who bought near the top suddenly realize they may have been wrong. Their optimism turns into concern. If the price continues falling, that concern becomes panic. They begin selling quickly, hoping to escape before losses grow larger. This emotional shift often produces sharp downward movements on the chart. Do you see how these emotional cycles create recognizable structures? Optimism leads to trends. Uncertainty leads to consolidation. Fear leads to sudden declines. And hope often appears during temporary recoveries inside a larger downtrend. Because these emotions repeat, the chart patterns created by them also repeat. Now consider the advantage of a trader who understands this. He does not view the chart as random noise. Instead, he sees the psychological behavior behind each movement. A breakout is not just a line being crossed. It is a moment when buyers have overwhelmed sellers. A support level is not just a price zone. It is a place where demand has repeatedly defeated supply. Let me ask you another question. When you look at a chart, are you simply watching candles form, or are you thinking about the emotions driving those candles? Because the experienced trader reads the chart like a story. He sees where traders became confident. He sees where they became uncertain. He sees where panic entered the market. And by recognizing these emotional footprints, he gains insight into what might happen next. This does not mean the market becomes perfectly predictable. No pattern works every time. Unexpected news, shifting sentiment, or sudden institutional activity can disrupt even the most beautiful chart formation. But the trader who understands repeating patterns does not need certainty. He only needs probability. If a pattern has appeared hundreds of times throughout market history, and if it has often led to a similar outcome, then it becomes a useful guide. Not a guarantee, but an advantage. And advantages, when applied with discipline, are what allow traders to survive and grow in the market. So when you look at a chart forming today, whether it is a breakout, a pullback, or a period of tight consolidation, you are not just observing numbers moving on a screen. You are watching the same emotional drama that traders have acted out for generations. Many traders enter the market thinking first about profits. They imagine the trade working perfectly, the price moving in their favor, the account balance climbing higher. Their attention is fixed on what they might gain. But the experienced trader begins with a different thought. He asks, "What happens if I am wrong?" That question alone reveals the difference between speculation and disciplined trading, because the market has a way of humbling even the most confident trader. No chart pattern is perfect. No analysis is immune to surprise. A trend that appears strong can suddenly reverse. News can arrive without warning. Momentum can vanish in a single session. So the trader who focuses only on profit is walking into uncertainty without protection. Now let me ask you something. If a man went sailing into a storm without a life jacket, would you admire his confidence or question his judgment? Trading without risk control is very much the same. Risk control begins before the trade is ever placed. It starts when a trader studies the chart and determines exactly where his idea becomes invalid. Perhaps he is buying a breakout above resistance. If the price falls back below that level, the breakout has failed. The reasoning behind the trade no longer holds. At that point, the disciplined trader exits. He does not argue with the market. He does not hope the price will recover. He simply accepts that the trade did not work and protects the remainder of his capital. But many traders struggle with this step. Why do you suppose that is? Because accepting a small loss feels uncomfortable. It feels like admitting a mistake. And human nature does not enjoy admitting mistakes. So instead of exiting quickly, the trader hesitates. He tells himself the price will come back. He widens his stop. He waits a little longer. And suddenly the small loss becomes a large one. This is how accounts disappear, not through one catastrophic trade, but through a series of uncontrolled losses that slowly erode capital. The professional trader understands something very important. Losses are part of the business. Even the best traders experience losing trades regularly. The difference is that they control the size of those losses. They treat them as a normal cost of participating in the market, just as a store owner accepts rent or inventory expenses. Have you ever noticed how calm, experienced traders appear after a losing trade? They do not panic. They do not rush into another trade to recover the loss. They simply move on to the next opportunity. Why? Because their risk was controlled from the beginning. If a trader risks only a small percentage of his account on each trade, a single loss becomes insignificant. Even several losses in a row cannot destroy him. His capital remains intact, and with it his ability to continue trading. This is the foundation of survival in the market. And survival is what allows growth. Think about the mathematics for a moment. If a trader loses half his account on one trade, he must double the remaining balance just to return to where he started. That kind of recovery is extremely difficult. But if he loses only 1 or 2%, the impact is minimal. The next good trade can easily offset the damage. This is why experienced traders respect risk more than they chase profit. They understand that protecting capital is what keeps them in the game long enough for their edge to work. Now, consider how this mindset changes a trader's behavior. Instead of forcing trades, he becomes selective. Each opportunity must justify the risk being taken. The chart must present a clear structure: support, resistance, trend direction, or momentum. If the setup is unclear, he simply waits. Let me ask you something. How many trades have you taken simply because you were bored or eager to be involved? Those trades rarely end well. The disciplined trader knows that every unnecessary trade exposes his capital to risk. And since risk is the one element of trading he can control, he treats it with great respect. He sizes his positions carefully. He places stop losses where the chart proves him wrong. He never allows one trade to threaten the survival of his account. Over time, this approach creates stability. The account may grow slowly, but it does not experience devastating collapses. And that stability gives the trader something even more valuable than profit: confidence. Not the reckless confidence that comes from a lucky streak, but the quiet confidence that comes from knowing he can protect his capital even when the market behaves unpredictably. And once a trader develops that confidence, the market begins to feel less like a battlefield and more like a landscape of opportunities waiting to be approached with caution. Many beginners enter the market believing that success will come from one extraordinary trade. They imagine catching a perfect breakout, a massive trend, or a sudden market surge that multiplies their account overnight. The dream is simple: one bold decision, one great opportunity, and the journey to wealth is complete. But the market rarely works that way. In fact, the trader who depends on one lucky trade is usually the same trader who eventually gives it all back. Let me ask you something. If a businessman built his entire company on one sale, would you consider that a stable business? Of course not. A real business grows through repeated, consistent results. One sale follows another. Small profits accumulate. Systems are refined. Discipline becomes routine. Trading is no different. The account grows through a series of decisions, not through a single moment of brilliance. Consider what happens when a trader catches one large win early in his journey. Perhaps he enters a breakout that runs far beyond expectations. His account suddenly grows much faster than he imagined. At first this feels exciting. Confidence rises. The trader begins to believe he has discovered something special about his own ability. But there is a hidden danger in that kind of success. Because when a trader believes his success came from skill rather than circumstance, he begins taking greater risks. He increases his position sizes. He trades more frequently. He becomes less patient because he expects the market to reward him again and again, and eventually the market reminds him that it does not reward excitement. It rewards discipline. That large win may disappear just as quickly as it arrived. Now compare this to a trader who approaches the market with a different mindset. Instead of chasing spectacular trades, he focuses on consistency. Each trade is planned carefully. Each risk is controlled. Each decision follows a clear set of rules based on what he sees in the charts. Some trades win, some lose. But over time, the results begin to show a pattern.